Ladies and gentlemen, my name is Clay Maitland. I'm with the Marshall Islands Ship Registry. This panel is, as you can see, a panel made up entirely of panelists, some of whom we've already heard from today. Amit, Randy, Fotis, Ben, and Mike. It's a little bit like when we were, some of us at least, were in high school, and people got prizes for being, most congenial, most sociable. In this case, it's going to be most bearish, most bullish, most correct. We always hope everybody will be most correct. So I'm going to start off by going down and I'm going to ask some questions. Bob Burke in the last panel, by the way, said something which is kind of relevant to what we're going to be doing today. Now, he said disruption is good. Sort of like greed is good. Disruption may be good for some people, but not for others. Depends on what business you're in. But in the work that you do, I'm going to ask you folks, starting with Amit, what do you like? There are maybe 6 sectors in our industry. There are probably a lot more, but we can talk about the ones that we all know and love. Dry bulk, containers, LNG, LPG, product carriers, and liquid bulk. We won't talk about offshore, okay? Please don't talk about it. It's like that old thing, don't mention the war. Do not mention offshore. What are your top 2 picks in these terms of sectors? I mean, what do you think is good? What do you think is bad? What are you avoiding? What are you telling your clients?
Sure. Well, thanks a lot, Clay. I appreciate the question. We cover all the verticals in maritime shipping, obviously, just like all my peers do here. I guess from our standpoint, we like to be a little bit more contrarian. We think, liking sectors when everybody else hates them ultimately leads to outperformance over a cycle. And so that's partly based on the fact that, we look at, when we analyze companies within specific verticals, we also look at balance sheets relative to market value of assets, how a company is positioned in terms of being able to deploy capital at different places in the market. So certainly the dry bulk market is in a better place today. I think in January of 2017 is when we upgraded the dry bulk industry, and certainly that call has worked out. And we continue to like the dry bulk market, but as we evolve now into maybe looking at the back half of 18 into 2019, we do like the outlook for the tanker industry, partly because VLCC rates today are $3,000 a day. We find that companies that are not well capitalized to endure that will be forced to, and in fact, many companies in the space are actually very well capitalized to actually turn that negative market environment into an opportunity for acquisitions, like you saw Euronav, for example, and their recent deal. So I think from our standpoint, we are getting much more positive on tankers. We have been for the last few months, and we think there's the weakness is sowing the seeds to a recovery over the next year or two.
Okay, quick follow-up. What don't you like? What's not to like?
From my standpoint, I'll be very company specific in this way, because I think that rates, in some ways, I'm agnostic to rates when I think about what to recommend from a company standpoint. I don't like companies that have stretched balance sheets, that have to, in any given environment, not prepared to endure a weak market. And so for me, I don't like companies that have loan-to-value ratios that are higher than 70% at any given point in the cycle, and certainly during the weak point in the cycle, because I think they're the most at risk of equity offerings and declines in equity value.
Thanks very much. Ben, do you agree with everything that Amit has just said?
Well, he's the smartest guy in the room, so I'd be an idiot not to.
See?
I will say on the bear case, well, first of all, we're shipping analysts, so we're never bearish. But I agree. I think increasingly, at least in my view, the equity markets are getting a little bit more grown up, and people care a little bit more about things like balance sheets and corporate governance than they used to. And I don't think that's going to change. I think it's been a tough lesson for a lot of people to learn, and even in a better market environment, if ship managers, if the management teams of companies and the boards of directors of these companies can't show prudence and with respect to their capital structure, they're not going to get the same premium just because they happen to own the right ships. So I think that's pretty important. On the things I like, dry bulk's okay. I think I like, probably it's small, but I probably like the LPG market the best at the moment. I think it's kind of well poised for a little bit of a recovery here.
It's you play that very safe. It's not like you. Randy, do you agree with what these two gentlemen have just said?
For the most part, I like the dry bulk sector a lot. Moderated the panel this morning and like it even more now. But for me, it's probably more so in the refined products tankers sector. That's probably my top sector pick.
Keeping score.
Sure. OECD inventories are now back below the 5-year average. You have refinery expansion of at least 800,000 to 1 million barrels a day, both this year and next. IMO 2020, that's a demand driver for them. For everyone else, it's kind of a supply benefit, but I think that increases some demand routes. And then on the supply side, for the refined products, it's maybe 2.5–3% at most this year and probably less than that next year. So that's probably my top sector choice. Second would be LNG, just with the liquefaction capacity of 8–9% this year and next versus a fleet growth of 6 or 7%. So you have some outpacing there of demand over supply.
Okay. Let's see. Michael. What are your views? The good, the bad, and the ugly. What do you like the best?
I would generally agree with Amit around the buy low, sell high.
This is group think, by the way. I'm already worried.
Yeah, I would generally.
It's Randy's opinion on Gian. That'd be nice.
Did you have a meeting outside to get your story together? Is it
Controversial. I would say I agree with certainly with what Ben's saying around corporate governance and the lack of a premium developing for companies and management teams that don't prioritize capital stewardship. I guess the one thing I would disagree with would be around the tanker trade. It seems like there's been an effort or some momentum to start the year that we could kind of globally grow our way out of overcapacity by the end of the year, and it would warrant a bid into tanker equities early. It seems like we're starting to come on the other side of that trade, and it's getting a little frothy. I don't think asset values in the tanker space are going to roll over anytime soon. If anything, just the inflationary pressure placed on assets by steel tariffs and the like should at a minimum kind of keep VLCC values where they are. The idea, it's tough for me to see us getting more constructive around the idea of global growth in 2018 than we already are, which makes me think that tanker investments right now are just a little bit early. And beyond that, what I like, I like LNG. Golar is my favorite name.
everybody likes LNG,
Golar and Gaslog Partners. Some of the LNG names are a little overextended. Some of them are trading at 1.7, 1.8x.
Yeah, that's
so some of them have some more ground to give up than others, but yeah.
Fotis, are you comfortable with what you're hearing?
I think the great thing is that having 5 analysts here is that you can have at least 6 or 7 different sectors that they might like. And if you had more analysts, probably they would even direct you to other sectors outside of shipping. The answer to your question is always contingent to what kind of horizon do you have, what kind of risk you want to take. Personally, I think depends on if you are looking for 6-month returns, probably yes, you can play still the dry bulk market, but if you are looking for much higher returns, you need to focus on, as Amit said, on sectors that they do not make money right now, but they can switch their fortunes within the next 12 to 24 months, like the tanker market, so it can switch from unprofitable to profitable. And if you want long-term returns, as Michael said, you can look at sectors that they grow very fast, like the LNG sector, which has very high growth rates. And if you believe that there's going to be a new wave of liquefaction capacity, even if this comes in 2023, 2024, we can have a new wave of demand for LNG carriers. So I would go to either with the tankers with a horizon beyond 2018, or LPG as well. It's pretty much the same story of US NGL production and US exports, and they can turn completely from losing a lot of money the last couple of years, from making a lot of money the following 2-3 years. 2018 is already gone for most of the investors. Or if you want to have a much longer term horizon, I think that the LNG market in overall, it's very interesting. The key, however, when you pick individual companies is cost of capital. The industry is not an industry which it gives money to everyone like it was happening between 2005 to 2008. You need to have a really significant cost of capital advantage. If you are safe bulkers and you borrow at LIBOR plus 150 or 200 basis points, you have a significant advantage compared to an average company that might be borrowing at LIBOR and 450 basis points.
I'm not sure Amit does. Do you agree with what he just said about cost of capital, Amit?
Yeah, I think that's one of the most important things, not just from the cost of capital, is also when you put that capital to work. I mean, when you look at the cost structure of a shipping company, you know, 2 of the 3 main pillars of costs are directly correlated to when you buy the asset. Not just the cost, obviously the cost of the financing, but also the, you know, the amortization of the debt and the debt tied to that acquisition price. And so for me, you know, companies, I mean, companies that create the most value over time, or maybe companies that don't destroy the most value over time, are the ones that, you know, acquire assets when it's unpopular to do so, and have the balance sheet and the relationships in the market to deploy that capital. And I'll give you a couple examples, both with actually the same company in Euronav in 2013, and then in 2014 purchasing the Maersk VLCC fleet, and then more recently with the Generate. That is exactly the type of capital deployment that creates value over time. And the companies, and the interesting thing in shipping is capital tends to be available in large quantities at exactly the wrong time. So the moment that, you know, there's a significant amount of IPOs or things like that, I mean, you can look at the Clarkson data going back on IPOs from 2010, 11, 12, 13. I mean, it was just like, it was like silly. And so I would argue that in certain segments where capital is most scarce is where you want to look in the secondary market or even the primary market for acquisitions, because that's where you want to be over the next year or two, or even longer, frankly. Now, sorry, last point for me is that as someone that's been somewhat bearish on everything that's related to shipping from a corporate governance standpoint, I will say that there is an opportunity for shipping to be a structurally better business or industry over the next decade. And that reflects 2 things. One is an increased level of equity that's required by the banks, by investors, and also structurally barriers to entry with respect to regulations, not just related to sulfur, but its emissions down after that. So I'm somewhat optimistic, cautiously, that the added equity in the capital structures can actually lead to less boom and bust cycles for the shipping industry, which will be good for analysts, will be good for investors certainly, and will be good for, you know, the world as a whole.
Thank you. Now, Randy, I saw you smiling. Was that just a grimace, or do you agree with what Amit just said about corporate governance? Because that was a very bold statement that I think he made just now.
Fully agree, fully agree. Couldn't say anything to add to that.
Good. Everybody else agree?
I think that why is everybody attacking the whole industry about the corporate governance? What about other industries? I mean, this is part of life. Every company has a different structure. I think that shipping is the most transparent industry in the world. Every day you can open your Bloomberg terminal and you can see what the Baltic Stock Exchange says is the rate. If you do not think that the company is performing according to the market, or it's underperforming, you do not have to buy, but you have all the data. You know what is the value of the ship. This doesn't happen in other industries. And I agree with Amit overall with the general thesis, but that there are better companies and worse companies, and there are some management teams that they have abused a little bit the interest of the shareholders. But this happens in every industry.
Oh,
I don't think
I
that
disagree
shipping
with
is,
respect. I think I cover 5 different industries. I've covered 10 different industries in my career. There is not one industry in the world that has the amount of corporate governance abuses of shipping. And to be honest, I'm not in the business of advertising my competitors' research, but Mike Weber and Wells Fargo, frankly, have done this industry a service by their scorecard, and I wish I thought of it first.
But the scorecard, some of us, we agree on half of the companies here. Some of the companies, the order can be different, depends on the criteria. At the end of the day is long-term, who is in the market? Who can manage to go through the ebbs and flows of the market successfully and survive? How about in OSVs? Do you ever know what are the rates for OSVs? Do you know in the drilling market, when someone signs a contract that was never disclosed in these sectors, in all these sectors, even in LNG, which is a very transparent, theoretically and well-governed industry, the companies right now, they are signing 20-year contracts, and we do not know what are the terms of these contracts. Is this transparency? Is this better than shipping compared to shipping that every day you go to the website of every company and you see what is the charter rate they charter with Trafigura, they charter with EDF. You see everything.
I would say that when they sign a 20-year SPA, we know they're not signing it with their uncle because they'd have to disclose it. I don't really want to talk about it too much. It's going to make me mad. But the idea that there's industry data and there's prevalent industry data, and that is the same thing as having clarity around corporate structures and related party transactions, is just misdirection. I mean, I don't think shipping is different in the sense that, or fundamentally flawed. If you look at trucking 10 to 15 years ago, or maybe 20 years ago, it was in a very similar state. There's a natural maturation to some of these sectors, but you can't sit here and pretend that there's not an issue when you see deals like we saw this week that Ben wrote about, where we've seen some of the it's deserved because no one else really tackled it. You can't pretend like there's not a problem. I do think the space is certainly getting better when you look at the quality of the new entrants. We just need to see a continued evolution. But the fact that we can pull up a day rate on Bloomberg does not tell me that I know that you're not seeing the siphoning off of value from related structures. It just doesn't tell me that.
Michael, you know that I was probably one of the first analysts that talked about corporate governance of certain companies and fees and commissions,
Sure.
But attacking the entire industry and saying that the industry is problematic. I mean, the industry is extremely transparent, and the industry has an advantage that whoever is not good and whoever abuses it, he's going to get a lower valuation because people know, and this is our job here to say who is good, who is bad, and there are very good companies, very well-run companies. And at the end of the day, the companies that, as Amit mentioned, that they have excessive leverage or they are mismanaging the capital that they have been trusted, they go bankrupt in this sector. And somebody else can come and buy the ship at much cheaper. Everybody knows what each asset worth, and everybody can make this judgment.
They don't go bankrupt. What they do is they take the fees from this related party management company and then use those fees to buy shareholders back at their own very discount. And so they don't go bankrupt. They just end up owning all of the equity for nothing.
Or they dilute 80-90%, which is effectively the same, no?
Look, I think it's important to make a distinction between bad actors and bad structures, right? So I think that simply because those structures are there does not mean they're being abused. But when you've got companies that have been trading at systemic discounts to NAV for more than a decade, and you haven't seen any material changes around management, around structure, around strategy, and everyone just seems happy with the status quo of trading below what their assets are worth, you have to ask yourself why. Why are we so happy with the status quo, and why would they be happy with the status quo? Again, not saying that those structures are necessarily being abused in all instances, but it's just simply a trade that equity investors shouldn't have to make.
But they are penalized, no? The investors, they do assigned below the NAV value valuation.
I think we're in a Darwinian moment here where
You took the words out of my mouth. I was going to use the word Darwinian, not to be aggressive about it, but because that's your vision of the industry, Fotis, is somewhat like, what we saw in the 19th century, survival of the fittest. And that's really what we've seen for the last 10 years, isn't it? Ben, what do you think?
No, I think that's right. And I think, as I said earlier, I think it is, and then again, in large part to some of the work that Mike has done, people care a lot more than they used to. And there is a distinct cost of capital advantage or disadvantage. And that, in this marketplace, that's what separates the winners and the losers. And if you can't, if you have materially, and just, I also to some extent agree with Fotis, if you have a material disadvantage in terms of your cost of capital, you're not going to be able to keep up. You're not going to be able to grow. It's going to be more expensive, and you're going to be marginalized. And ideally, in grown-up industries, those marginalized companies are soaked up or absorbed by the bigger, more well-run companies. Unfortunately, that's still a problem, I think, in this industry. There's too many ship owners and not enough employees at the behest of their shareholders.
I agree.
And I'll agree with what Ben was saying. The investors are much more aware of that. Like in the last 2 or 3 weeks, I've gotten a few inbound inquiries. We see what the fleet is, we see what their rates are, we see what their asset values are. What about the corporate governance? What about the management teams? Are they doing, insider dealings? Is there in-house chartering or technical management fees or, transaction fees? So that's what they want to know about, and that's something hopefully we can provide after 5, 6, 7, 10 years of analysis, I guess.
Aside from just obvious normal stuff with respect to related party transactions, look at companies' reported GAAP earnings relative to their quote-unquote adjusted earnings. And typically companies that have the widest gap tend to be the companies that are most concerning. And I've never seen a gap wider than I have in the shipping industry. And largely those gaps reflect restricted stock awards that sometimes go up to 15, 20% of the diluted share count that have been awarded to the senior management of the company. And the equity has done nothing but go down. So also the other thing I'll just add is an equity analyst who publishes research that gets read by basically everybody that is interested in that particular stock or industry, there is a little bit of a shoot the messenger mentality in the industry, which puts us as analysts a little bit, I don't know if you guys have the same feeling, but there are some examples of companies or companies really attacking the messenger for highlighting some of these related party transactions. And I think that's an important point that needs to stop for the industry because equity analysts are migrating more towards highlighting this. They're evaluating it in their valuation metrics and their ratings, and I think that is generally a good thing for the industry, and certainly investors are rewarding analysts that do that, and I think that's also an important point.
Anybody else want to add to this? One of the things that I think needs to be said is that analysts perform a very important service. I don't know when you go home at night whether your kids ask you what you do at the office, Daddy, but you do perform a very important service. The biggest service you perform for people like me, who are basically service providers in my company, is that you are the people who are at the coalface, as the British say, when in terms of dealing with investors. In other words, Bob Bugbee a little while ago said that there aren't too many things that keep him awake at night. Well, there is one thing that keeps me awake at night, and that is, where will the money come from? And I know we all sit here and we talk about private equity, we talk about a lot of different kinds of investment, but basically, if the shipping industry is to grow, we're going to need a investment coming from a lot of different directions. And frankly, where do the investors go? They go to you. Now, I'd like you to comment on that. I know that's a sort of a milquetoasty sentiment, but have you ever really looked at your jobs and what you do and how it affects the pattern flows that we were just talking about, that you've been talking about, all 5 of you, in the last few minutes, last half hour really? In other words, where the money is going to come from and how what you're doing could influence that and influence it in a positive way. Because when we talk about over-tonnaging, when we talk about the mistakes that have been made over the last 10 years, a lot of that was, as was pointed out by you a few minutes ago, caused by the wrong kind of investment in the wrong things at the wrong time and in the wrong amounts. We have a chance to do a sort of a do-over now. It's true that you never really learn lessons, do you, in this business, but it would be nice to think that you can pattern what you do to remind people of what the mistakes were starting in 2007, 2008. And also, by the way, the mistakes we didn't make in this industry. Sorry to make that little speech. But I want to provoke you to take this in a slightly different direction.
You let Michael speak. Since I've been speaking a lot, we can start from that side. If that's
Okay, why don't we go down, Michael, your end?
Well, yeah, I mean, look, at the end of the day, we're in suits at the Metropolitan Club. We're not jumping out of a Higgins boat, snoring on a beach, right? So it's not, I don't know that we deserve that much credit. Look, I don't worry about capital availability that much. Returns will rise to the point that it'll attract the capital if needed. You kind of worry about what the tenor and the investment horizon is of that capital, but I'm sure, as all these guys would attest, you're just kind of trying to keep up with inbound calls and whoever's reaching out to you, and you just kind of, we get a bit of a vantage point into the evolution of the capital sources, but I don't know that we necessarily get to shape them. But in terms of, look, I think there is certainly less capital available today than in past cycles. I think that is showing up lots of different places. The biggest of which is when you look at these stocks, when you look at trading in any of the commoditized shipping names, they're NAV trades, and you kind of pick a trough NAV, and you pick a mid-cycle NAV, and generally lop off the portion of the curve between mid-cycle and peak. And that's because the capital that would have typically come in to take you out of that kind of mid-cycle rate thesis is no longer there. The cycles are getting shorter. The investment windows are getting shorter, and I think that's in part a function of the breadth of capital availability. But again, I don't think that we shape what capital is there. We just happen to get a view of it as it passes by.
I would say, to some extent I agree, but the reality is that of the five of us up here, every one of us has a colleague who is in the capital raising business. So it's not an accident that we're sitting here, which is the real challenge, because people our clients are counting on us for good investment decisions, but our firms need to also make money. And in balancing that is a challenge, frankly. And I think that we can have, and historically, the analyst community and their opinions, coupled with what management teams are saying or whatever, can certainly drive the groupthink of the broader investing community. And sometimes that's not always right. I certainly don't have, maybe Randy does, but I certainly don't have a 100% track record in terms of getting all my stock picks right. And the challenge for me is to be able to sometimes step back and say, is there something else that is shaping my views here that shouldn't be having an impact?
Anybody else up front want to comment before I go back to the audience here and ask you for your views?
In terms of new capital, in the past couple months here, a lot of our energy analysts, the E&P guys, the oilfield services, even the MLPs are kind of forwarding clients to me, and kind of see the thread, and then it says, what about shipping? And they say, Randy, take this one. So you're starting to see some new energy investors kind of enter the market. Instead of paying, a discount of $70 WTI for an E&P company, they're kind of looking at some of the ancillary energy businesses and shipping, obviously with a higher risk, higher reward, and a lot of new entrants to the market just in recent months.
Some market cap restrictions, right? So, there are very few companies that are investable by the largest of institutional investors. I also think investors' interests, look at shipping differently. There's a cohort of people that look at it as a portfolio shaping tool, introducing a little bit of beta into their portfolio, and if it goes to zero, it goes to zero. Then there's another larger group of investors that will never touch shipping, no matter what the upside is, because they know the downside is zero. And then obviously there's the corporate governance aspects of it too. So I think there's a couple. So I mean, from my standpoint, the secondary investor interest has always been few and far between in shipping. Certainly in 2013, it was very, very strong. It dwindled basically to nothing in 2016 and 17, and now we're starting to see it pick up a little bit, which is encouraging, but certainly nowhere near where it needs to be to, justify a significant amount of resources.
There is plenty of capital. I will agree with Mike and Ben. I mean, 2013, when the dry bulk industry was at the trough and many companies were facing bankruptcies, there was plenty of capital there to save these companies. And because this capital was looking to get 30, 40, 50, or 100% return. Sure. Today, yes, there is no capital because as we see, most of the dry bulk companies and tanker companies, they trade below NAV. It's like telling the market, this capital, don't buy more ships, don't invest in new buildings. I'm not valuing you to the levels that the private market is valuing you. The moment that the market starts believing that returns are going to be better, or at the moment that you come up, Clay, with a few ships that they have 5-year contracts, that they make double-digit returns, I'm sure that there's going to be plenty of capital, and all our colleagues on the capital market side would want to finance it.
Just to add, because it's been kind of a negative tone, I guess, around this, but there is still plenty of institutional capital that looks at shipping, right? You can get an institutional bid into Kirby, into Golar, into Gaslog, into Cheniere. I know a couple of us cover that. It's really the traditional bulk names that are smaller in cap and have more checkered histories, where it's much, much tougher to get a robust and sustained institutional bid. But I cover 35 names. At least half of them I've got ongoing institutional dialogue for the last 10 years. The other thing I would touch on is, I think Randy mentioned new energy investors. I think that's actually kind of emblematic of what we're seeing in terms of kind of the lack of new money coming in at the moment, where most energy investors I talk to are pretty frustrated right now. You've got all the dedicated guys that got the fundamental call right. Brent went to $60. Fundamentals are working, and all the stocks are kind of breaking at mid-cycle, which is the exact same thing we saw happen in shipping last year and the year before. So to that point, there is capital availability. The issues that shipping faces in terms of not attracting a bid in the top half of the cycle is not something that's, not an issue for shipping on its own. It's an issue across the board. It actually makes me a little bit worried about the tanker trade everyone's talking about too. The fact that, if you can't get a bid into a services or an E&P name or a major with Brent at 60 and a pretty constructive forward curve, to me, that tells me that we're going to start to get a bit more cautious around global growth, or at least the market is not giving anybody the benefit of the doubt anymore when it comes to expectations for 18 and 19. So,
just to add one more thing on this energy investors hedge funds and why there is a little bit, it's much more challenging to find easy capital like it was a few years ago. Mm-hmm. Shipping is predominantly bought by energy hedge funds, as Amit said. 90% of the investors are energy or energy educated related hedge funds. Energy, it used to be in 2014, 11% of the Russell 3000. Today is less than 2%. So when these energy hedge funds, they have lost all their money, and all the money is going to generalist or to tech investors, there is no capital to invest in shipping. That's why the cost of capital has gone up. And the other difficulty that the capital markets and the equity investors are facing is, or even the debt investors in the US capital markets, is that there's plenty of very cheap capital from China, from Japan. There's no sane US investor that is going to go and give a loan at 4.5%. Like a Japanese or a Chinese leasing fund. And that's the difficulty in deploying capital at these competitive levels.
in the back, is there a question? I see a question in the front. You don't have a microphone, but we might be able to fix that, so at least I can hear you. Thank you.
Thank you. You all touched on corporate governance. There was a deal done in late February, the Aegean deal. Can we go through all the panelists? The Aegean. Can we go through all the panelists? Can you rate it from 1 to 5 from a corporate governance perspective?
Aegean?
One being bad and 5 being good.
Yeah.
Negative 150,000.
Anybody else want to comment on Aegean?
I don't cover the company, so I can.
Yeah, I never heard of it.
I've written pretty extensively on it. I think in general that was a poor deal in many respects.
I don't cover it either, but I tend to, without knowing all the details of it, the arguments that I've seen written seem pretty compelling.
It's a Marshall Islands company, by the way, so I will not comment on it. I'm not an investor in it, I'll tell you that. Anything else? Anybody else? Going once? Cocktails are outside. Mr. Bornozis, would you be willing to make a few concluding remarks? I want to thank our panelists for being very thoughtful.
I have different views on a number of topics.
Very
but I don't
impressive
think that
bunch of
we,
guys. Thank you very much.
Thank you.
Thank you.